This winter, the road to Wall Street is filled with potholes. Just ask Goldman Sachs. Quarterly profits nosedived 21% at the end of last year, stung by a drop-off in fixed income trading as investors prepared for a jump in interest rates. Citigroup, hit by the same problem, made worse by that bank's inability to find enough cost savings to bring profits ahead of forecasts. The results echo that of JP Morgan Chase, which, along with slower fixed income revenues, also had to dish out $850 million for failing to report suspicious activity related to Bernie Madoff's historic Ponzi scheme. Heading into earnings season, analysts were predicting 22% earnings growth for the sector, expectations that are proving to be lofty, according to Dick Beauvais of Rafferty Capital Markets.
We're in that, if you will, changeover from reducing costs to get earnings to selling products to get earnings. And I don't think they've quite yet reached the selling product stage. The first quarter, I think you will see the big increase in product sales or revenue generation. And I think at that point, maybe something on the order of 12 to 15% would be a more rational view of where the earnings might go.
But that changeover is already bearing positive fruit in at least one big surprise this quarter. Bank of America is finally digging out of the deep hole it fell in during the financial crisis when it brought troubled lender Countrywide Financial. Profits leaped by nearly $3 billion as revenues at some units jumped to a record. Also working in its favor, the number 2 U.S. bank no longer has to worry about so many loans made before the crisis turning sour thanks to an improving economy. Old loans, however, are no longer the industry's biggest problem. New mortgage lending at B of A was only half of what it was the previous 3 months, and at Wells Fargo, the country's biggest lender, a rise in auto loans only partially offset the slowest mortgage lending in 5 years. Add to that the Volcker rule, which prevents banks from making speculative bets with their own money and stops certain kinds of investing, and the industry won't get much boost from trading either, unless...
If it's correct that we're going to see a big increase in M&A activity and a big increase in IPOs, then trading will turn around and start to recover, somewhat meaningfully.
Increases in the stock. Shares of Citigroup tumbled more than 4% following its results after rallying 32% last year, and Goldman Sachs lost more than 2% after a 39% return in 2014. Morgan Stanley, however, may avoid the same fate when it reports on Friday if catering to wealthy clients pulls in the big dollars it did in previous quarters.